charges. So, but I would say I do many of these loans a month, and in most cases, the fees run between $125 and $150 for the session. So it's about between 45 minutes and an hour.
Okay, good. So one more question to clarify for listeners. Is the counselor, what kind of training have they had and who do they work for? Are they a government employee or how's that set up? Just so people feel more comfortable about knowing who they're talking to and is that person, qualified and that sort of thing.
Super question. They have to take an exam, and they get a certificate from FHA. So these are all FHA certified counselors, and many of them do many kinds of housing counseling, first-time home buyer counseling, and so forth. And some of them only do reverse mortgage counseling.
Interesting. Okay. Well, that, because there's so many misconceptions about reverse mortgages. I just want to take the time while I've got you here just to explain in detail so that people don't feel so nervous. But I guess the worst question is, can somebody who does this be kicked out of their home? What conditions have to exist to have that happen? Or is this hey, I can stay here for the rest of my life, I don't care?
Absolutely. It is possible for someone to lose their home. If you do not pay your property taxes, you can lose your home. And I always try to make that as abundantly clear to both homeowners and to homeowners' families that the property taxes must be paid. Now, in many cases, homeowners are property tax exempt. Most jurisdictions in the United States have property tax waivers for the elderly or the disabled. And that's a matter of actually applying with the county for the property tax waiver. However, if you are not property tax exempt, you must keep those property taxes paid. And one issue with this becomes, at 65, rarely is remembering to pay your property taxes an issue. 75, also not so common, but at 85, 95, my oldest client ever was 103. Well, it can absolutely become a lower priority, or homeowners simply can forget. So I urge homeowners to please talk to family members and have family members give what I call the talk, which is the money talk with parents, which can be quite awkward, but it is absolutely crucial. So your question was, can someone lose their home? Yes, they can lose their home. The 3 requirements are, and I'm actually going to expand it to 4 requirements, but number 1, pay your property taxes. Keep them paid up, paid on time. Number 2, you have to keep the home insured with homeowners insurance. Number 3 is just routine maintenance. This is just normal homeowner stuff. Don't let a tree fall on your roof and neglect to repair the home. And then number 4, you have to occupy the home. So you can't move out and use it for an Airbnb or a rental property. You have to maintain this home as your primary residence. Now, the feds do allow for your going into the hospital, rehab, whatever might happen health-wise, as long as you're back home within 1 calendar year, and then the clock resets. And that can become a factor as we age. Somebody may fall, break a hip, go to the hospital, but not come back home, but rather go to rehab. But as long as you maintain that home as your primary residence and keep it insured, you're fine.
So if somebody is a snowbird, for example, and they live 6 months in the summer, they live up in Maine, and then in the winter they go to Florida, is that possible to have that kind of reverse mortgage in effect, or does that not qualify them?
Nope, absolutely. Absolutely. Now, we check driver's license. We have to show that they actually are living as the primary residence in the home.
Right.
They say they are, but yeah. The second homes are absolutely fine.
Okay, that's a good thing. I do have a question. I had a client once who asked about this, and the husband is in his 70s. The wife is in her 50s. Do they qualify for a reverse mortgage?
They do. Now, the loan to value will be based upon the wife's age because she's not yet 62. So the loan to value is always based on the youngest homeowner's age. But because just one member of the married couple or the couple, they don't even have to be married actually, is over the age of 62, then yes, they qualify. Now, the younger they are, so if somebody, and this is a real situation, but I had a couple many years ago where he was in his 70s and she was 26. The loan to value on that is so low, it makes it almost an untenable situation. It's just hardly even worth it at that age. And the loan to value is maybe, I can't remember anymore, but they qualified for maybe 25% of the home value of the home equity. So it didn't make any sense in their case. But well, can there be an age spread where one is younger than 62? Yes.
That's interesting. Well, so say they live in the house and yada, yada. And so what happens after the homeowner moves out? What happens to the house? How is the loan? What happens to the loan and all that?
Okay, great. There are 3 scenarios typically. One is the second to die homeowner has passed. The heirs or the estate will typically will sell the home. The loan is repaid at the point of sale. The heirs or the estate inherit the rest of the equity. And I always like to put this in terms of time frame. I do have a website where I've got some resources, but we can address that later. But the first thing that happens is the heirs have to reach out to the servicing authority and say, my parent passed in the night. I need to know next steps. And servicing will then send the family a to-do list, and they have 6 weeks to meet the first congressionally mandated deadline. You have to do some certain things within 6 weeks, and then you get to the next time limit, and they would like you to have the house sold within 6 months. If you can't sell it, then they do within 6 months, and they give you 2 optional 3-month extensions. So the family also, if they'd like to retain the property, they can just repay what's due. So
ask who died. They wants the house, yeah.
Mm-hmm. Just refinance the debt into their own name or repay it in cash. So that's scenario 1. Parent has passed. Last homeowner to die has passed. Number 2, the last occupying homeowner has transitioned into managed care. Scenario 2 is the second occupying parent has moved into managed care, so has transitioned into other housing. And statute gives this person 12 months to get well and get back home. But if that doesn't happen, then the adult kids or the heirs have to decide what to do with the home. Typically at that point, they'll go ahead and sell the home, or they'll repay the loan and retain the home. One thing that can't happen is you can't use that newly vacated home as a rental property. So this loan is for the homeowner and not for heirs to move into, nor is it to be used as a rental property. So, and then the third situation is mom and dad decide to move to Florida. They just simply sell the home. The loan balance is repaid at the point of sale, and then mom and dad take the rest of the equity with them.
Interesting.
So one thing I'd like to point out is that the lender doesn't get the home. That's a big myth with reverse mortgages, is that somehow this is the lender's scheme to get the home. That does not happen. One thing I would like to address is what happens if the sale of the sale price of the home cannot cover the loan amount. If something dire has happened to the economy and you can only sell the home, I always like to use the illustration of $20,000 is all you can get for the home. So this would be an apocalyptic scenario. The home still is sold for whatever the market will bear. If that is less than the loan amount, that FHA mortgage insurance pays out to protect the homeowners, the heirs, and the estate, and no other assets are at risk. So even if they have $1 million elsewhere, that money is not forfeit, but rather the mortgage insurance covers the shortfall.
Interesting. Well, I did happen to think of something real quick. What happens if you're earning Social Security benefits and Social Security? What does that include in anything, or can you keep getting it, or what? How does that affect the entitlement with a reverse mortgage?
Sure. And this question comes up a lot because of the age qualifications for a reverse mortgage. So we're going to address three common scenarios. One is Social Security. If you've paid into Social Security, you will get Social Security, and there's really nothing you can do to mess that up. So Social Security is a benefit, and it's technically called an entitlement, so that is not touched. Medicare is another entitlement. Medicare is, of course, health insurance for people over the age of 65. But then there's Medicaid. Medicaid is completely different. Medicaid is income-based and needs-based. So once you deplete your assets and fall below a certain income level, you may qualify for Medicaid. And this is the one where people must tread very carefully. I work with, I actually teach attorneys. I teach a continuing legal education class from time to time. And this is one that a lot of attorneys are interested in because they're always looking for ways to couple a reverse mortgage with Medicaid. And it can be done under certain circumstances, but you have to be informed as to the rules, the regulations, and the restrictions. So the only thing I would say is if somebody is a Medicaid recipient, then they need to talk to a reverse mortgage specialist who is experienced in dealing with reverse mortgage and Medicaid benefits.
That sounds like a logical solution there. But we only have a couple more minutes left, and I just want to ask, because of all the things you've said, it sounds like reverse mortgages are really not as bad as people make them out to be. And I'm just wondering, why do you think they've gotten such a bad rap? How's it changed over the years, maybe, or what's different now?
Well, they have a bad reputation because they used to be a bad product. There's just no two ways about it. Many, many years ago, back in the early 60s, the first couple reverse mortgages were privately rolled out by community banks, but they quite quickly fell into the hands of predators. And there are a lot of documented cases of people who would prey on older homeowners. In many cases, these were widows. And it's just a gruesome history of elder financial abuse. The Fed stepped in, cracked down on these, and then they really disappeared from view for many, many years, all the way through most of the 70s, the 80s. Nobody heard anything about reverse mortgages. Back in the late 80s, under the Reagan administration, the idea of reverse mortgage was brought back into the spotlight, and there was a lot of market testing. There were a lot of legislative tweaks that took place, and the modern reverse mortgage program was rolled out, and it bears almost no resemblance to the original predatory product. The concept is similar. Somebody can borrow against the equity in their home and have the home repay the debt on the back end. But when people compare this to the early predatory product, it's not an apt comparison. There really is no similarities other than the general concept.
It sounds wonderful, and I know that listeners are going to want to ask more questions. So would you please close out the show by getting your email, website, whatever would be proper for them to be able to contact you? And by all means, this has been a really great program, and I do appreciate your taking the time out of your schedule to talk to the listeners, because this is one topic that just causes all kinds of hot spots and remarks. They just don't want to hear about it, and I think this is totally different, like you said. So share with the listeners how they can reach you.
Sure. My website is Middleburg Reverse Lady. Middleburg is spelled with a B-U-R-G, Middleburg Reverse Lady. And my email address is Laurie, spelled out the long way, L-A-U-R-I-E, at Middleburg Reverse. And I'm always happy to answer questions. And this can be truly a trajectory-changing product for the retirement years.
It certainly is, and I do thank you so much again for joining us today, and I'm sure that there will be a lot of questions about this and follow up. And thanks for coming on the show, Laurie. We appreciate it.
Well, Thank you so much for having me.